My name is Blair Williams, and I'm going to be analyzing 15 companies from 3 different industries. The first industry is the teen and young adult clothing stores. We have American Eagle, Abercrombie & Fitch, Aeropostale, Urban Outfitters, and Delia's. Which company to invest in? I picked Urban Outfitters because they have the highest return on equity, the highest operating margin, and they have the lowest equity multiplier, which is good because they're making the highest return on equity with the lowest amount of debt. They have the best EVA, the highest price to earnings ratio, which means that investors predict a higher growth for this company. They have a higher asset turnover for the past 5 years. They have increasing financial leverage, which shows us that they're taking more advantage of debt. When we look at this industry's liquidity ratios for 2013, we see that Urban Outfitters is the most liquid company, and Delia's is the least liquid company. Only their current ratio is over 1. If we look at the return on equity breakdown, we see that Urban Outfitters has the highest ROE, which is driven by their ROA. We see that Delia's has the lowest ROE, which is driven by their extremely low ROA. The breakdown of ROA for this industry, we see that Urban Outfitters has the highest ROA, which is because of their high profit margin, and Delia's, their profit margin also drives their low ROA. If we look at the breakdown of profit margin, we see that the cause of Urban Outfitters' high profit margin is their extremely high operating margin for the year, and Delia's has a similarly low profit margin for the year. For Urban Outfitters, we see that they have a really high current ratio, telling us that they can pay all of their current liabilities using their current assets. They can also pay their current liabilities using just cash. Their financial leverage has stayed pretty consistent over the past 5 years, but they're at their highest in 2013. Their asset turnover is also the highest that it has been over the past 5 years in 2013. If we look at their profitability ratios, we see that their operating margin has increased from 2012. Their price to earnings ratio is also the highest of all 5 companies, and it has increased since 2009. If we look at American Eagle's liquidity ratios, we see that they are also all over 1, telling us that they can afford their current liabilities using their current assets. And their asset turnover is also at its high from the past 5 years. If we look at their profitability ratios, we see that operating margin is at its high over the past 5 years, and this causes their profit margin, return on assets, and return on equity to also go up. And we see that their price to earnings ratio has dropped from the previous year, but it's also pretty high. If we look at Abercrombie & Fitch's liquidity ratios, we see that over the past 5 years, these ratios have mostly been over 1, but for 2013, they can't afford their current liabilities using just cash. If we look at their profitability ratios, we see that their return on equity started off in 2009 pretty good and decreased in 2010. However, it ends up at 12.6% in 2013, which has increased from the previous year. If we look at Aeropostale's liquidity ratios, we see that their quick and cash ratios are identical, telling us that this company does not have any receivables. Its asset turnover has stayed pretty consistent over the past 5 years. Their profitability ratios show us that in 2012 and 2013, this company's operating margin has decreased significantly, also decreasing their return on equity. For Delia's, we see that their quick and cash ratios are also identical, telling us that this company also does not have any receivables. Their profitability ratios show us that the only year that they've had a positive return on assets and return on equity was in the fiscal year 2009. Every year since then it's been negative and consistently decreasing. For this industry's EVA, the high was Urban Outfitters at 124.54 million. And Aeropostale had a low of negative 202.54 million. My next industry is travel info and booking web services. We have Expedia, Priceline, Orbitz, Travelzoo, and TripAdvisor. Which company to invest in? I picked Priceline because they have a very high operating margin. They're a very liquid company. They have the highest short-term ratios over the past 5 years of all 5 companies. They have the highest profit margin in the industry and the highest in the past 5 years for this company. They are more than able to pay off their interest debt. Their leverage is pretty consistent over the past 5 years, and they have a very high price to earnings ratio. If we look at the liquidity for this industry, we see that Priceline has the highest liquidity ratios. Their current is extremely high at 5.41. Compared to Orbitz, who has the lowest at 0.43, showing that they cannot pay off their current liabilities using their current assets. If we look at the return on equity for this industry in 2013, we see that Priceline has the highest ROE at 34.82%. We see that this ratio is driven by their high return on assets, which is 22.24%. Compared to Travelzoo, who has the lowest at negative 13.42%, this is also driven by their negative ROA at negative 4.71%. We look at the breakdown of return on assets, showing us that Priceline's high ROA is driven by their high profit margin. Travelzoo's negative return on assets is also driven by their profit margin, which is a negative 3.16%. This is the only profit margin of the industry that is negative. If we look at the breakdown of profit margin for this industry, we see that Priceline's profit margin of 27% is driven by their high operating margin of 35%. This is extremely high in this industry. Travelzoo's negative profit margin is driven by their negative tax burden. For Priceline, we see that the current ratios are very high. The current ratio is very high for this company. We see that it is at 5.41% for this year. It's a high from past 5 years. Their cash ratio is also very high, showing that they can pay off their current liabilities using only cash with no problem. Their financial leverage for this company is very consistent over the past 5 years. Their asset turnover has decreased throughout the 5 years, which isn't a good sign for the company since for 2013 and 2012, it's below 1. For Priceline's profitability ratios, we see that over the past 5 years, their operating margin has increased, which is good, showing management's doing a good job with their operating expenses. Profit margin has slightly increased since 2012, but this is an increase since the year 2009. Their price to earnings ratio for 2013 is a lot higher than 2012, showing us that investors expect growth for this company. For TripAdvisor, we see that their liquidity ratios are also pretty high, and they can pay all of their current liabilities using any form of their current assets. Their profitability ratios show us that their operating margin has decreased from the previous year, and it has also decreased for every year since 2009. This caused their return on assets and return on equity to also decrease for the year 2013. For Travelzoo, we look at their liquidity ratios, and we see that in 2013, these ratios for their current and quick are above 1, showing us that they can pay off their current liabilities using their inventory and receivables. However, for their cash ratio is below 1, and this shows us that they cannot use their cash to pay off their current liabilities. Their financial leverage is at a high for the past 5 years, showing us that this company is taking advantage of debt. For Travelzoo, over the past 5 years, we look at their profitability ratios, and we see that between 2012 and 2013, their tax burden has significantly decreased. Also, their interest burden has decreased a lot. This caused their profit margin and their return on assets to also decrease. We look at Expedia's liquidity ratios, and we see that for the past 5 years, they're all under 1, telling us that this company cannot pay off their current liabilities using any form of their current assets. Their financial leverage, however, is at an all-time high for the past 5 years, and this shows us that they're taking advantage of more debt, which will magnify their gains and losses. For this company's profitability ratios, we see that since 2011, their profit margin has been decreasing. However, from 2009 to 2010, their profit margin was increasing, showing us that this company is not keeping a higher percentage of their sales for their profits. When we look at Orbit's liquidity ratios, this company also has extremely low liquidity ratios, showing us that they cannot pay off their current liabilities using any form of their current assets. So for any of the past 5 years, their liquidity ratios aren't even at 0.5. For Orbit's, they have their profitability ratios. We take a look at their tax burden. From 2012 to 2013, they have a very significant increase, and they have an increase in their interest burden, which caused an increase in their profit margin, an increase in their return on assets, and they have a price to earnings ratio of 4.37, which shows us that investors do expect a high growth. For the travel info and booking web services industry, we see that for the EVA, Priceline has an extremely high EVA. We have 1,339.13 million. And for Orbit's, as a contrast, we see a negative 127.22 million, which is an extremely big difference. The third industry I have is casinos and gaming. We have MGM, Boyd, Penn, Pinnacle, and Isle of Capri. Which company to invest in? I picked MGM because even though all companies have negative ROEs, this company has the highest of the ROE of the industry. It's the most liquid company of the industry, and it has the highest cash coverage ratio for the 5 companies. And for the past 5 years, 2013 is their highest cash coverage ratio. They have a high operating margin also, so this shows that management's doing a good job with that. If we look at this industry's liquidity ratios for 2013, we see that Pinnacle has the highest current ratio at 1.6, and Boyd has the lowest at 0.7374, showing that they cannot afford their current liabilities using only their current assets. We see that MGM has the highest quick ratio at 1.0346, and Pinnacle has the lowest at 0.6055, showing that they can only afford their current liabilities using all of their current assets. For this industry, we see that all 5 of the companies' cash ratios are below 1, showing that none of the companies can afford their current liabilities using only cash. The breakdown for return on equity for this industry, we see that MGM has the highest return on equity at 3.64%. The driving factor for this is their return on assets, which is the highest of the industry at negative 0.5978%. The lowest is at a negative 77.4% for Pinnacle, which is driven by their negative 7.04 return on assets and their high equity multiplier of 10.9991. The breakdown for return on assets for 2013 of this industry, we see that MGM has the highest return on assets at negative 0.5978, which is driven mainly by their profit margin, which is negative 1.5%. We see that Penn has the lowest return on assets, which is negative 20.2947%, driven by their extremely low profit margin of a negative 27.215%. If we break down these profit margins that's driving their ROAs, we see that for MGM, they have a negative 1.5964 profit margin. The reason that this profit margin is negative is their negative tax burden, and we see that for Penn, their negative 27.215 profit margin is driven by their extremely low interest burden. For MGM, we take a look at their liquidity ratios. We see that their current ratio is above 1 for all 5 years, showing that they can afford their current liabilities using their current assets. However, for their cash ratio is only above 1 for 1 year in 2011, showing us that they can't always afford their current liabilities using just cash. Their financial leverage has been pretty consistent over the past 5 years, going between 5 or 6 to 4. Their profitability ratios, we take a look and we see that from 2012 and 2013, they had a high increase in their operating margin. We see that it went from 1.3853 to 10.8918, causing their profit margin, return on assets, and return on equity all to increase. We see an extreme increase between 2012 and 2013 of their return on equity, going from negative 33% to negative 3%. We take a look at Boyd's liquidity ratios, and we see that for the past 5 years, none of them have been above 1, showing us that this company cannot afford their current liabilities using their current assets. We see that their cash coverage ratio has decreased since 2009. Even though they can still afford their interest, they're a little more constricted now. This company's financial leverage ratio, however, has increased a good bit since 2009, showing us that they're taking on a lot more debt than they have in previous years. If we look at their profitability ratios, we see that from 2012 to 2013, this company had an interest burden that increased a good bit, causing their profit margin also to increase and their return on assets and return on equity to increase a good bit. We see that this company does not have a price to earnings ratio for the past 2 years, showing that they're struggling a little bit. If we look at Penn National Gaming, their liquidity ratios, we see that they took a dip between 2010 and 2012, going below 1, showing us that they couldn't afford their current liabilities using any of their current assets. However, in 2013, it rose up again. It's above 1, about close to 1.5, showing us that they can now afford their current liabilities using their current assets again. However, their quick and cash ratios are still below 1, showing us that they do need all of their current assets to afford their current liabilities. We see that this company's financial leverage has stayed pretty consistent over the past 5 years. If we look at their profitability ratios, we see that their interest burden has increased since 2009 to 2012. However, from 2012 to 2013, their interest burden decreased a whole lot, going from 83.72% to negative 254.02%. This caused their profit margin, return on assets, and return on equity to also significantly decrease in 2013. If we look at Isle of Capri's liquidity ratios, we see that most of the past 5 years they have been below 1, showing us that this company cannot afford their current liabilities using their current assets, and their financial leverage has taken a dip in 2010, 2011, and 2012. However, it's back at 9.596 in 2013. We see that Isle of Capri's profitability ratios have caused this company, their return on equity has increased from 2012 to 2013. In 2009 and 2011, these are the only 2 years this company has had a positive return on equity. So this company is kind of struggling a good bit. Their price to earnings ratio, however, has increased since the previous year, showing that investors do expect a good bit of growth from this company. For Pinnacle Entertainment, we see that their current ratio has gone up and down for the past 5 years. We see that It hit a high in 2012 of 2.9841, and in 2013 it dipped back down to 1.608, and we see that even though it dipped in 2013, they can still afford their current liabilities using their current assets. However, using their receivables and cash, they can't pay off their current liabilities using their current fees. Their financial leverage, however, has increased significantly from 2009. From 2009 to 2012, their financial leverage had been pretty consistent, and it jumped a lot from 2012, going from 4.2003 to 10.9991, showing us that this company now has a lot more financial leverage, and it's going to affect how their profits and losses are magnified. If we look at Pinnacle's profitability ratios, we see that their interest burden has increased significantly from 2012 to 2013. This caused their return on equity to decrease from negative 6.5814% to an extremely low negative 77.44%. This is not a good sign for the company, showing us that they're not making a good profit from any of their assets or any money that their shareholders have invested. For this industry, we look at the EVA, and we see that MGM is the only company that has a positive EVA, showing us that they have made a lot more than they were expected to, at $524.28 million, even though their ROE was still negative. They did better than expected. However, Penn, they have a negative $642.86 million EVA, which shows that they did a lot worse than investors had expected. Overall, I would pick Priceline to invest in because they had the best liquidity ratios. They were increasingly high over the past 5 years. They had extremely high cash coverage ratio, showing that they could afford their interest expense. They have a consistent financial leverage, showing us that they have an okay leverage in their company and debt financing. They have a high tax burden, and they have an increasingly high operating margin, which is good. They have an increase in profit margin and an overall high ROA and ROE for the company. They have the highest PE ratio of all 15 companies, and they have an extremely high EVA. Thank you.